Personal finance practice problem using OneNote. Business with franchise fees break-even point. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab down in the 6150 Business with Franchise Fees Break-Even Point tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got the information up top, calculations on down below. We're looking at a scenario where we're starting a business or thinking about a business scenario in which we have to pay a franchise fee to participate in the business model, that being in essence a fixed type of cost, and then we're paid a commission on the sales that we make. We're going to say at the 30%. So in general, the basic question there would then be, no matter what type of franchise it is, we would like to think about how much sales we would need to make first in dollar amount and then possibly in units if possible in order to at least clear the franchise fee. Now, this is generally the way we want to think about these types of situations. Breaking out the costs into fixed costs and variable costs can often be useful as well. You can apply a similar kind of situation on any basically production type of business that you put together. You're making jewelry, you're making necklaces, you're making, if we have a hot dog stand, a hamburger stand, or something like that, then it's often useful to try to break down the costs that you think are going to be fixed, that will be set over the period time frame, like the rent of the hot dog cart, which is my standard example on that, versus those that will change as you produce more and sell more, which would be the hot dogs themselves and the buns and that kind of things, so that you can make these projections into the future. This is a similar type of scenario here. We'll start off with a more simplified situation in which we don't really have any costs because we're assuming that those are going to be taken care of by the franchise, the business basically, and we're just going to be getting the 30%, on the sales amount. And so therefore we got to see how many sales we need to make to get to that 7,750. So the general calculation would be the franchise fee is $750. The commissions per sale are going to be 30%. So if we take the 750 divided by the 30%, which would be 750 divided by 0.3, that's going to give us the 2,500. In other words, we would have to sell 2,500 so that if we multiply that times 30%, we would earn 750 of it, and that would then clear the franchise fee. Now, the next question would be, of course, well, what is it that we are selling? Because some types of things we have a franchise for might mean that there's a whole bunch of products that we're selling, and people can choose whatever they want on this whole giant list of basically products that could be sold within it. And that could be a little bit more difficult because, of course, then we have these different products that have different price points and so on and so forth. And other types of franchises, we might have one particular thing that we're selling. And if we have one particular thing that we're selling, it makes it a little bit easier for us to focus in on that one thing and try to determine how many of those one things we have to sell. So I won't get into too much detail when you have multiple different products, but the general idea is that you'd want to think about, well, where's my focus really going to be on the types of things that I'm going to sell? What are the things that are going to sell most for me? And then see if you can break that down into basically a per unit type of calculation, meaning what's the cost of that particular thing, and then you can basically see how many units we need to sell. In other words, when we look at the dollar amount of sales, useful but somewhat abstract. It could be more useful for us in decision making to see if we can actually do this, to break down the dollar amount into a per unit item amount, which is easy to do if you're selling one kind of thing, more difficult to do if you sell multiple kinds of things. If you sell multiple kinds of things, you might then want to take the average amount or focus in on that particular thing that you think is going to be most marketable. That will help both with the marketing of the things you think are most marketable and the determination of how profitable you think this thing could be. So then we can take that if we're saying we're going to sell the units that are going to sell for $100, then how many of these things would we have to sell? Well, if I got to get $2,500, 2,500 divided by $100 per thing that we're selling, we would have to get 25 of these things sold in order to clear at least the franchise fee, just to have it to be breaking even. And then, of course, and that's often, even on a franchise, oftentimes you lose money when you start off on the franchise. Some people do these kind of franchise just to build a community, because then you could talk to people about these things and whatnot. That can even be useful, even if you're running at a deficit. It might be you might still enjoy doing it, but and even if on a profit seeking, you might end up running at a loss. And then, of course, in the future, as you get better at this, then of course you might be generating more revenue if you run it for a longer period of time. So the next question would then be, well, what if I wanted to make a profit of, let's say, $5,000? So $5,000 on the year of profit. Notice when we think about profit or any of these calculations, there's got to be a time frame. Are you talking about profit per month, per year, per week, and so on? So we'll say, 5,000 we're going to try to make on this. So 5,000 plus, that's what we want to be making over and above the fixed cost. The fixed cost, which is the 750, that would give us 5,750 that we would want to earn. 5,750, and the commissions for the sales are 30%. So we'd have to say, okay, 5,750 divided by 0.3 would mean that we would need to be making sales of 19,166, about 0.66, 19,167, because if I sold that much in dollar amount times the 30%, 0.3, that would give us the 5,750, 750 of which minus 750 I would have to pay to the franchise, leaving us with the profit of the 5,000. So you could do the same kind of calculation to kind of figure out what the profit would be. And then again, if you got that 19,167, the next question is, well, how much things do I have to sell? And then that gets more complex again, of course, if you have multiple different things, but you break it down and say, well, if I'm selling about $100 per thing that I'm selling, then the 19,167 divided by 100, about, we could say 19,167 divided by 100 is 192 things that we would have to sell. And then you can think about how likely it is that you'd be able to do that, or how would you do that? How would you put that together? Now, another more traditional, this is kind of like a break-even type of analysis. So if you're doing a break-even, I'll just put it in a break-even format, so that if you see this in a slightly more complex type of situation, possibly something where you're making something so that you have costs per unit and possibly fixed costs, then your idea oftentimes is to be breaking out the variable costs and fixed costs. And the fixed costs, kind of most common examples, like the rent, like if it was a hot dog stand, the rent of the hot dog stand is what it is, no matter how many hot dogs you make and sell, right? Whereas the hot dogs themselves, the buns and whatnot, will vary per unit, and you'll try to break those out to a per unit basis, and that will help you to determine how many hot dogs you would need to sell to make a profit, and how many you would need to sell in order to generate, a certain amount of revenue in a similar fashion. So in that case, we would break this out. The standard calculation would be that we're going to take the fixed costs divided by what we would call the contribution margin, which would be the gain that we're going to get per unit sale. So typically it would look something like this. You'd say the 750 is our fixed cost. That would be like the rent on a hot dog stand, or like the franchise fee here. And then the contribution margin in this case is going to be the revenue to us per unit, which I'm just going to say is every unit we sell, we get 30% of it. So I'm just going to say it's $30 per unit that we get in revenue, not including the fixed costs, just including what I will call the variable components, the variable revenue, and then minus the variable costs, which there are not any at this point, because the cost of the things that we're selling, we assume, has been figured out to be within the franchise fee calculation. And so that would give us $30 that we are then generating on our unit contribution margin, which would be the sales price per unit minus the cost per unit. And that's how we would normally get to our break even in units first. If we were doing some kind of production business, 750 divided by 30, and that gives us 25. So we'd have to make the 25. And then, of course, if I want the break even in dollars, we could say, how much are we selling these things for? We're selling them for $100, even though we only get to keep $30, the 30% of it. So times 100, that gives us then our 2,500. So same kind of result that we got in this calculation up top here, but it's going to be, this is kind of the more conventional way if you're producing types of things. And then let's add one more, which is a little bit wonky, a little bit unusual with this scenario. But if you're making things like hot dogs or jewelry or something like that, then this will fit more into that context. If we were to say that we're going to add on a cost to us per unit. So a cost per unit. So everything we sell, we're going to have a cost of $10 to us per unit, just so we can add a cost to it. So we'd have the same thing, fixed cost $7.50. The unit contribution margin would now be, we're getting $30 of the 100 that we sell, but we're going to assume now that each thing that we sell costs us $10, right? Which might not always be the case in like this kind of franchise that I'm kind of imagining here. But if you were making like hot dogs or something like that, you could say that the rent on the cart would be $7.50, and then you're earning $30 per, hot dog package or something, minus the $10 you're selling them at a place where people really want hot dogs, and then minus the variable cost per unit. And we're going to say our $10 for all the things because they're really expensive they're a giant hot dog or something. So that's going to be, then the difference is the contribution margin of the 20. So, and then the question is, well, how many of those things that you sold do you have to clear the fixed cost to clear the fixed cost? And so that's the typical way that we'll set these up when we kind of manufacture things, $7.50 divided by 20. Now, note that in about 37.5. Now, note that as you break things into these categories, the fixed costs and the variable costs, it's a little tricky to break them out because they don't fit perfectly. I mean, you might say, hey, I got to buy so many hamburger buns, and even if I don't sell that many hamburgers, then I'm kind of out the money for the hamburger buns that I sold and so on. So they're kind of fixed if you bring the time frame down. But in general, they're more variable. So these things, you're going to try to break things out between fixed and variable so that you can do this type of analysis, even though it's not a perfect world. And obviously, it's a helpful tool. It's a helpful approximation. So that's going to give us the 38. And then again, you could take that times the 100. That would mean you'd have to sell revenue of $3,750. And then if you were to say that you wanted to get a profit of $30,000, you do a similar kind of calculation here, but now we're going to say the fixed cost plus the profit would be the $750 plus the $30,000 we want to be making. That means we have fixed cost plus the profit of $30,750 divided by the contribution margin, we call it, which is the revenue to us per unit, 30% of the $100 or $30. Cost per unit we said was $10. That means we have the contribution margin of 20. So if we make $20 for every item that we sell, we got to pay for the cart of the $750, and then we want $30,000 of profit. We'd have to say 30750 divided by 20. We'd have to sell 1,538 about of these things over well, let's say a year, I guess, on this thing or something like that, right? And so then if we multiply that times 100, because that's the sales price, how much we're selling them for, that would give us the sales amount, which would be $153,750 in sales in order to get that 30,000 of the profit.